Thank you, everyone. Nevin, thank you for the kind introduction. Well, today I'm here to talk about Fo's private debt strategy. So let's talk a little bit about Fo growth. We'll have to go past a couple of slides here. There is some, thank you. Some forward-looking statements that my compliance officer wants you to read in 20 seconds. And a disclaimer that I'll give you about 10 seconds for. So, who is Fo growth and what is our purpose? Fo growth is about democratizing institutional investments. And what exactly does that mean? Now, we know that the average investor cannot typically access high-quality institutional investments, partly for two reasons. First of all, the best opportunities are reserved for a select group of institutional clients and those in the know. And secondly, minimum investment levels can be extremely high, at least over $1 million, and they have long lock-up terms, so the terms are very long. So, at Fo Growth, our founders recognize the need to empower everyday investors by opening up the world of institutional investing to them. And so we are very excited about our latest strategy, which is private liquid debt. Now, before I talk about the strategy, a little background is necessary. Banks have been tightening lending standards for two main reasons. The first reason is the Dodd-Frank Wall Street Reform and Consumer Protection Act. And one of the many outcomes of this law was that banks were required to retain at least 5% of the credit risk on their books for any loan or asset that was not a qualified residential mortgage. The second reason is the Basel III regulatory framework. And what that really did was they put forward rigorous capital requirements, stringent leverage ratios, and liquidity requirements. Now, as a result of this, banks began to restrict lending. So, because of banks tightening lending standards, companies were shifting more towards private debt. And what private debt really does is it allows companies to pursue innovative and flexible structures. And let me give you an example. For example, if a company wants to look at debt, they can actually take in several maturities, 3 years, 5 years, 10 years, and then if they are a multinational organization, they can take various currencies, put it all into one deal, and get the deal done. Secondly, it also, this thing is running away from me, so just a little bit further behind, sorry. They also allow faster closing speeds because there's no need for public disclosure. And then finally, it gives you flexible covenants, both for the investor as well as the company. So what exactly is private debt? Private debt can take on the form of bridge financing, which are short-term collateralized loans. So a company will take on this loan until it can get permanent financing in place. It can also take on the form of private mortgage pools, factoring and receivables investing, and finally, direct lending. So, in our next chart here, we show that private debt is still fairly small compared to private equity. At private debt, you're looking at about $650 billion, and private equity, which is on the left-hand side axis, is about $2.5 trillion. However, it's growing at a much faster pace. So why invest in private debt? Private debt has three compelling features: high income yield, downside protection, and diversification. Let me briefly expand on each of these three. Private debt managers are able to exploit market efficiencies and also extract a premium for illiquidity, and that results in higher income yields. Most of the private debt deals are asset-backed investments. And besides that, most of those investments are also floating rate agreements. So these assets provide downside protection not just because of the collateral backing, but also in a rising yield environment. Finally, it offers diversification. Just because, let's take for example that you are a balanced fund, okay, and you have a huge correction in the equity market. So what does a balanced fund manager do? He gets a whole lot of redemptions. He doesn't sell what he can sell, he'll sell what hasn't taken the correction yet. So chances are he'll sell the bond portion of the balanced portfolio. And so that is why private liquid debt offers that advantage in terms of it's immune to technical adjustments in the public market. So our next slide shows that institutional investors are beginning to put more and more money into private debt. If you look at these 4 large North American sophisticated pension funds, together they add up to about $40 billion, but we expect those allocations to only grow for the reasons we highlighted before. So how do private debt managers manage risk? First of all, risk management is very similar to corporate bonds. So there's management through diversification of strategy, diversification through geography, diversification through sectors and industries, finally diversification through managers, and the managers themselves go through a lot of rigorous credit analysis to pick counterparties with low credit risk. So let's go through a case study, a sample fund introduction. This is looking under the hood of one of the managers we are allocating capital to. They have almost $1 billion of assets under management. They have achieved average annual returns of 10.8%. They've had no down months since inception, which is November 2012. And finally, they have a very experienced team that helps borrowers adopt institutional practices across key functional areas. Now, I have spoken about some of these key features before, but I'm just going to read them out. They capitalize on the decline in traditional bank lending, collateral-backed private debts. They compare favorably to fixed income investments. They have diversification once again across strategy, loans, user proceeds, industry sectors. Here's the important thing though. It offers quarterly liquidity. In the previous chart, what I did not draw your attention to was that almost 42% of the assets were allocated to receivables financing, and that's very short-term financing. So that's why this particular manager is able to offer quarterly liquidity, and finally consistent returns. Now, we'll try and cover a couple of case studies here and look at some of the sample investments so that we can take a look into this opaque world of private debt, just so that investors get an idea of what these investments entail. Our first case study looks at financing high-quality, short-duration business. Now, what happened here was the fund actually formed a healthcare receivables management company. And the model entailed paying healthcare providers, hospitals essentially, upfront for patient receivables at a discount to face value. Now, such receivables were subject to recourse agreements, whereby the healthcare providers would buy back the receivables at face value if the collections were unsuccessful. And most importantly, that is not mentioned here yet, the recourse normally kicked in within 90 days. Our second sample investment is something that a lot in the Chinese community are very familiar with, real estate investing. And here we're really looking at outsized returns via the trustee sales channel. Now what they do here is they look at the auction of bank-owned property, which is extremely lucrative, but it's also inefficient and difficult to access without scale, a lot of capital, and experience. So here the fund partnered with a fix and flip real estate operator, And this operator is focused on purchasing property through this trustee sales channel. Now the actual firm manages everything internally: sourcing, underwriting, valuation, termites, remodeling, construction, eviction and sale. Most importantly, when you look at some of the average winning bids, discount to face value, they've given themselves quite a bit of buffer when they make these bids. Our third investment sample is something very unique. It's insurance premium finance. Essentially what the fund did was, it came up with a tailored capital solution to provide financing for installment payments of consumer insurance payments. The biggest advantages here was the funding was essentially done at a discount. Secondly, even though consumer payments actually are the source of payment, in case the consumer doesn't pay, the fund's borrower could go back to the business, which would be the plan administrator or the dealer. And finally, even if the plan administrator or dealer weren't able to pay, the insurance company's balance sheet was the ultimate insurance obligator. Now I want to quickly talk about FoGrowth's past investments. So we've had quite a bit of success in bringing innovative, different strategies to the average investor. Now our first fund, the FoGrowth Grenville Royalty LP, was offered in late 2016. The fund co-invested with one of the leading royalty finance and venture capital companies in Canada in growing private businesses, predominantly in the industry technology, as well as the services sector. The fund exited in 2018 with a 10% internal rate of return for the fund investors, including paying a quarterly dividend. Our second fund, the FoGrowth Power Income Fund, essentially here there was a collaboration with Canada's top private equity manager, Kensington Capital Partners. And the fund provided investors with the ability to make private investments in the Canadian clean tech sector. Once again here, the fund took advantage of opportunities with better pricing in Alberta to exit one of the major assets within the fund, and hence they were able to get out at a premium over there. And soon after they did that, the fund received 3 offers in Q2 of 2018 for the remaining portfolio of assets. So right now the fund is going through a wind down, and we expect those payments to be made before the end of September. FoGrowth has a seasoned management team, and I'm joined by some members of our Vancouver team here, including our Regional Director of Sales, Lin Chen, who runs our Vancouver office. Now at FoGrowth, we will continue to strive to find innovative research ideas and strategies, and we'll continue to work closely with Wistom Capital in bringing these products to market. I would like to thank Wistom Capital for giving us the opportunity to come here and present to you. And I'd like to thank you, the audience, for coming to this conference and being such a wonderful audience. Thank you again.
Thank you. Thank you, Jim. 我希望大家还能记得我在一开始的时候讲过，我们要一起造一台 SUV 啊。那我们跟 FoGrowth 的合作将会是我们在温哥华造的第一台 SUV， 而这辆 SUV 会结合各个方向债权投资的安全性、不同性，带给客人最好的产品。那今年下半年呢，我们也会在温哥华 launch 我们的第一个和 FoGrowth 合作的债权基金。这个基金的名字将会是 Wistom Strategic Income Fund， 也就是策略收入基金。好，那最后我们还有一位嘉宾，他非常非常的重要啊，因为他能帮我们解决很多的问题。他的名字叫 Tony Yu。那在加拿大这个地方，可能他是我见过在税务里面最有权威的人了。他曾多次获得加拿大总理和 CIA 颁发的杰出贡献奖， 最重要的是，在125年的加拿大建国奖，他也是获得者之一。那他在加拿大税局有超过38年的工作经验。那么现在我们有请 Tony 来帮我们解决很多问题。